afternoon, and thank you all for joining us today. I am NIN Desai, and I will be your host. I started my professional career at Merrill Lynch with their private client group. At Merrill, we manage portfolios of high net worth individuals. While it was great to trade stocks and bonds, I was always curious about how these companies went public. Thus, after business school, I joined Pacific Securities. PCS is a tech-focused investment bank with a global presence focused on software, communications, semiconductors, and internet and digital media. Here are a few transactions I worked on at PCS. In 2005, IPOs were at the peak, and it was amazing to take all these companies public. But that led to another question. How do VCs know what companies to invest in and which ones to take public? Thus, after business school, I joined Alpha Capital Partners. Alpha is a generalist fund with about $135 million of assets under management. My most recent transaction at Alpha was SIRCON, a software as a service provider company. The 2008 financial meltdown led to a liquidity crisis for entrepreneurs, companies, LPs, and VCs. Fewer IPOs means no exit for VCs, no return for LPs, and as a result, venture funds were on decline. No new venture funds means less startup funding, low employment, and slow economic growth. Thus, on April 5, 2012, the Jumpstart Our Business Startups Act was introduced, which enables crowdfunding for all accredited investors. Crowdfunding is a practice of funding a project or venture by raising contributions from a large number of people, typically via the internet. The market is flooded with various types of crowdfunding options like donations, rewards, lending, equities, royalties, and even hybrid versions. The two most popular types of crowdfunding methods are rewards and equity. For rewards-based crowdfunding, entrepreneurs pre-sell a product or service to launch a business and sometimes send in return for gifts or thank you notes. For equity crowdfunding, the backer receives share of a company, usually in exchange of the money pledged. In case of NIN.VC, it will be limited partner interest in the NIN Ventures Technology QP fund. Since 2014, the crowdfunding industry has grown from $16 billion to an estimated $34 billion in 2015 and is doubling or more every year. And according to the World Bank estimates, crowdfunding will have a global market of $96 billion by 2025, which is 1.8 times today's global venture capital industry. While the Obama administration achieved success with the Jobs Act by creating jobs for the economy, it also did a disservice to the people of the United States by encouraging crowdfunding in companies directly, which exposed them to a high degree of risk with such an asset. With the traditional venture capital investment process, we were all indirectly invested in a venture capital fund via a pension fund or institution. Those pension funds and institutions had a diversified portfolio. On top of that, they were investing in venture funds and not companies. So what is the difference between investing in companies and investing in a fund like NIN.VC? Number one, diversification. A fund or NIN Ventures Technology QP fund makes multiple investment in companies in different sectors, for example, 3D printing, cloud computing, education software, etc. For Series A and B financing, this strategy helps diversify a fund's portfolio, which is not the case when one invests in a company directly. Think of it as investing in mutual fund versus a stock. High risk. Given its diverse portfolio, a fund reduces its risk when, as direct investing in a company exposes that investment to a high degree of risk. An appropriate analogy would be to put all your eggs in one basket. Now, a logical follow-up argument would be, what if one makes multiple direct investment in companies of their choice using crowdfunding portal over investing in a fund? Given 90% of startups fail, even if one invests in several companies via a crowdfunding portal, it becomes solely a numbers game, quantity versus quality. On the other hand, the fund management invests in an entrepreneur because entrepreneurs build companies and not the other way around. We at NIN.VC or any venture fund not only provide adequate financing, including follow-up financing route and access to our syndicate partners, we also lend our domain expertise and network of partners to help companies with recruitment, PR, marketing, and a viable exit strategy. Number 3, professional management. Direct investing in companies require time, expertise, due diligence, constant follow-up, and/or monitoring. On the other hand, NIN.VC acts as a financial advisor and works for the investor in the fund's best interest. The fund also provides quarterly audited financial statements to the investor on the progress of the fund. Board representation. For example, a $1,000 direct investment in a company using crowdfunding does not give an individual enough rights, while a venture fund or NIN.VC takes board seat on all their investments. Thus, we are in the loop with the company management when it comes to keeping tabs on the progress of the company, and are in the position to help or make suggestions on several occasions, and also gauge and be a part of the valuation process when it comes to addressing dilution and follow-up financing rounds. Currently, majority of crowdfunding investors are pouring their money investing in companies directly and exposing themselves in the American economy to a high degree of risk with a 90% startup rate failure. And like I mentioned before, 2015, crowdfunding is estimated to be $34 billion, and according to the World Bank estimates, it's doubling or more every year and will be $96 billion by 2025. Thus, replacing smart money with crowdfunding justifies its short-term effects or the jobs created? Did Americans bail out a U.S. economy, or are we waiting for another bubble? Given the long-term 5 to 10-year venture capital investment cycle, we will probably not see the negative effects of crowdfunding for a few more years. However, to make matters worse, recently the SEC approved Title III Jobs Act, equity crowdfunding for non-affiliated investors, which allows any U.S. citizen, regardless of income, to make direct investments via a crowdfunding portal. But an investment in a fund like ours is still limited to accredited investors. What is an accredited investor? An accredited investor is an individual with an income of more than $200,000 per year or a joint income of $300,000 in each of the last 2 years, or has a net worth exceeding $1 million either individually or jointly with his or her spouse, excluding the primary residence, or entity or any trust with total assets in excess of $5 million qualified. There are multiple ways to verify if you are an accredited investor. For an individual, it's an income test, asset test, or a third-party verification. For an entity, it's assets and third-party verification. Given funds are less riskier asset class compared to crowdfunding companies, are American people given the wrong kind of freedom when it comes to their investment decisions? While there is a major flaw with crowdfunding in general, it does allow investors to direct invest and enjoy direct returns in an investment of their choice, which is not the case with a traditional venture capital fund. Since crowdfunding is a practice of funding a project or venture by raising contributions from a large number of people and eliminating the middleman like pension fund managers. NIN Ventures is a first of its kind technology venture capital fund to be marketed, raised, managed, and reported online, which gives people the freedom to directly invest in a fund with the amount of their choice, which also leads to a better financial reward system. The general solicitation and general advertising under the Jobs Act and Rule 506C of the U.S. Securities Act made it possible for us to raise this fund. This rule came into effect September 23, 2013, and we were the first ones to go live with a website and videos about our fund. NIN Ventures also became the first venture fund to be seen on a billboard, which was followed by in-taxi ads and other social media facilitated marketing. NIN.VC has been recipient of numerous awards, and I was also awarded 2015 CE of the Year, Illinois, for innovation and contribution to the venture capital and private equity industry, including Private Equity Fund Manager Year fund manager to watch for 2017, and most recently as a technology VC fund for year 2017. NIN.VC is a hybrid between a traditional venture capital fund and a crowdfunding portal. Why are we doing that? There is a major flaw. There's another major flaw with crowdfunding, and that is what NIN.VC is solving. I come from an entrepreneurial family, so I can speak on their behalf. Entrepreneurs are brave and courageous bunch that are determined to change the way an existing industry functions. On that journey, they need a lot more than just financing. They need guidance or domain expertise, help with PR and marketing, recruiting, viable exit strategy, more often follow-up financing, etc., which crowdfunding portals are not able to support. On the other hand, crowdfunding exposes investors to a whole new asset class, which the population never had the knowledge or expertise to invest in. As we all know, about 99% of startups fail. On top of that, low minimum investment like $1,000 does not really give them a say or a board seat, putting investors at a high degree of risk. At NIN.VC, we solved all those issues. NIN.VC provides diversification. We take board seat on all our investment and lend the necessary support that an entrepreneur needs to build a business, like they would get at a traditional venture capital fund. The most important part that investors care about is the ability to direct invest and enjoy direct returns, which is not the case with a traditional venture capital fund. NIN.VC has the best of both worlds. We are a hybrid between a traditional venture capital fund and a crowdfunding portal. The market is flooded with various investment vehicles, including stocks, bonds, mutual funds, IRAs, real estate, and alternatives like venture capital, among others. However, most people are short-sighted and have a dimensional portfolio, which is stocks, bonds, and money market, versus taking a long-term approach and investing in alternatives like venture capital. Investing in alternatives allows true diversification and also helps mitigate the risk involved in having just a traditional portfolio. For example, YALE. YALE is currently the best performing endowment fund in the United States. Since 2008 to 2015, YALE has increased its asset allocation in private equity and venture capital from 20.2% to 33%, out of which 16.3% is venture capital, compared to 13.7% in 2014 and just 10% the previous year. In general, most people have a three-dimensional portfolio: stocks, bonds, and money market. But if you look at Harvard and Yale's portfolio, they take a long-term approach and invest in alternatives like venture capital. Why do they do that? Historically, if you look at U.S. Venture Capital Index and S&P 500, U.S. Venture Capital Index tends to outperform S&P 500. And not only that, they have an inverse relationship. This type of investment strategy allows true diversification and also helps mitigate risks involved in having only a stock and bond portfolio. Like I mentioned before, most people are indirectly invested in venture funds via a pension fund or any other investment vehicle. Crowdfunding allows them to directly invest in a fund of their choice, and by eliminating the middleman, that is the pension fund and their management fee, allows them to generate higher returns. Now a little bit about the fund, or NIN.VC. NIN.VC is a $25 million early to growth stage crowdfunded technology venture capital fund. We invest in Series A and B rounds and write checks anywhere from $1 to $5 million. So now the question is, why are we doing early stage technology venture capital? If you notice, from 2002 to 2015, technology investments have dominated the venture capital industry. And the highest amount of venture capital funding occurred in early to expansion stage companies. If you notice, from 2000 to 2015, technology-focused funds have outperformed U.S. venture capital index, and generally, first-time fund managers tend to outperform non-first or other VC funds. So what does NIN.VC invest in? At NIN.VC, it all starts with a disruptive technology. A disruptive technology is an innovation that changes an existing industry and creates new value networks, displacing earlier technologies or way of doing business, just like how we're changing the venture capital industry. At NIN.VC, we start with an entrepreneur. We invest in an entrepreneur because entrepreneurs build companies and not the other way around. Being an entrepreneur is the hardest job in the world, and entrepreneurs face various challenges when it comes to taking disruptive technologies to market. A few attributes that we look for in an entrepreneur is the ability to dream big. experience and expertise in their industry, ability to communicate with the team and outside, flexibility to adapt to a fast-changing environment, and certain personality traits like being focused, dedicated, disciplined, hardworking to accomplish their goals. As long as the company has certain ingredients like a good management team, disruptive technology, a viable product, a revenue-generating strategy, that forms a basic foundation that leads to long-term success. We at NIN.VC like to invest in companies that are going to stand the test of time. Every sector at some point is up for disruption. Our focus for 2017 is primarily on 3D printing, fourth industrial revolution, cloud computing, virtual reality, financial services technology, education software, and other path-breaking sectors within the United States. Our goal is to invest in the next big trends within these sectors. So, what are multiple ways of investing with NIN.VC? There is a wide range of options when it comes to investing in the NIN Ventures Technology CP Fund, using checkings or savings account, defined benefit plans, self-directed IRAs, and even digital currencies. A defined benefit plan is a retirement plan that can invest in a wide range of securities and investment products, including venture funds. Some of the advantages of investing from a defined benefit plan are all contributions made to the plan subsequently invested are top-line tax deductible to the business, whether the business structure is sole proprietorship, an LLC, LLP, PC, C Corp, S Corp. The investment growth is tax deferred under the umbrella of the defined benefit plan. The contributions might be significantly greater than that of the 401k profit sharing plan to help increase the retirement savings account for the business owner. To invest in NIN using defined benefit plan, you must first sign up on NIN.VC, verify that you are an accredited investor. Next is to establish a defined benefit plan with Robin Weingart and Associates or a provider of your choice. Once the plan is established, contributions is calculated, and you can complete the subscription process on NIN.VC. We also let investors invest in our fund using retirement plans, for example, self-directed IRAs. Self-directed is a descriptive term that is used to describe how IRA providers administer the assets they hold. With a self-directed IRA, the client controls their IRA investments. Self-directed IRA allows investors to hold alternative assets within their tax-deferred retirement plans, such as private placement and venture capital. Like any IRA investments, a self-directed IRA has built-in tax-deferred growth, and thus an individual will not pay capital gain taxes on the growth of the investment. The return will flow back to the self-directed IRA and will not be taxable to the account holder. A self-directed IRA allows true diversification that is otherwise not achievable in a standard IRA portfolio. To invest in NIN Ventures using self-directed IRA, you must first sign up on NIN.VC, verify you're an accredited investor. Next step is to establish a plan with the interest group or a provider of your choice. Once the plan is established, you can complete the payment and subscription process on NIN.VC. Digital currencies, for example, Bitcoin, Litecoin, Dogecoin, is emerging as a new form of alternative payment and global currency. We at NIN.VC understand the significance of this change, and thus allow digital currency owners to attain liquidity in return for an investment in the NIN Ventures Technology QP Fund. Now let's go to the investment process step by step in detail. The very first step is to log on to NIN.VC to sign up. Sign up is simple. First name, last name, email, password, and acknowledge that you are an accredited investor. Once you sign up, you get access to our marketing materials, PPM, investor presentation, and other suggested readings. You also get invited to attend our events and calls. You can schedule a one-on-one meeting with us or at our office or online via Skype. Once you decide to make an investment, accept the risk and disclosure statement that will explain what venture capital investment is. The next step is to verify accreditation. Once that is in order, it's only a matter of filling out a subscription document and a W-9 form on NIN.VC. The last step is payment, and it's as simple as selecting the payment method and the amount you wish to invest. Please note that venture capital is a high-risk, high-reward investment vehicle, and we strongly recommend reviewing the other suggested reading on our website before making any investment decisions. Unfortunately, we do not have time for questions today, but feel free to reach us at contact@NIN.VC or 312-953-0930 to schedule a one-on-one meeting or with any questions or material requests. I'm going to leave you with a video, and thank you all for joining us today.